Welcome to today's video where we are going to dive deep into Benjamin Graham's classic, The Intelligent Investor, widely considered the investing Bible.
Today, we're going to break down Graham's key principles, showing you how they can turn you into a successful investor.
We'll be discussing defensive investing, enterprise in investing, margin of safety, Mr. Market, and more, and showing how Graham's wisdom is still highly relevant today. To make these concepts easy to grasp, I'll be using real-world examples. By focusing on value with patience, analysis, and discipline, you'll learn that there's a high probability of achieving long-term success. Now let's start with the principles that Graham believed defensive investors should follow. The aim is not to lose money, rather than making risky bets trying to beat the market. Here are some of his key principles. First off, always invest with a margin of safety. This means only buying assets when they are priced significantly below their intrinsic or true value. This buffer protects you from any potential errors or declines. Now second, diversify your portfolio across 20-30 different stocks and bonds. This strategy avoids having too much exposure to individual stocks. Diversification provides a form of insurance, just like covering enough numbers in roulette. Third, focus on high-quality, dividend-paying stocks. You'll want to look for stable companies with consistent earnings and dividend records over many years. Avoid speculative stocks and instead focus on established businesses. Next, adopt a long-term approach and don't panic during market declines. Have faith that your quality assets bought at a discount will pay off over time. Importantly, you should know your circle of competence and refrain from investing in businesses you don't understand. Stick to what you know best. Avoid trying to time the market, as studies prove that most investors fail at predicting market swings. Instead, use formula investing with set allocation to stocks and bonds and rebalance periodically. Lastly, consider passive index funds that simply match market returns. They are ideal for most defensive investors, as they provide diversification and help remove emotional decision-making. Moving on to enterprising investors. These are those who are willing to devote more effort for higher returns. Graham provided several approaches for this. Start by looking to buy undervalued stocks. This involves performing detailed analysis of financial statements to identify stocks trading far below what they are intrinsically worth. Another method is to buy nets. These are stocks priced below net current asset value, or current assets minus total liabilities. Graham made high annual returns by nets. Invest in special situations, events like restructurings, mergers, spin-offs, and bankruptcies that cause price dislocations. You can also engage in arbitrage, taking advantage of price differences between identical or related securities. Practicing value averaging is another option. This involves increasing investment in stocks as their prices decline to bring down your average cost and maintain exposure. Investing in undervalued stocks that pay reasonable dividends is another effective method. They provide income and stability. Finally, look for bargain issues, such as distressed or overlooked bonds and preferred shares selling below investment value. Throughout all these strategies, Graham emphasizes patience, analysis, and discipline. Don't follow the crowd or chase quick profits. As Graham put it, the investor's chief problem, and even his worst enemy, is likely to be himself. Despite being over 70 years old, Graham's lessons from The Intelligent Investor remain highly relevant. Here are a few of the key lessons. Focus on value, not hype, and insist on a margin of safety when investing.
Take a long-term view of your investments and don't let Mr. Market's daily mood swings force you to change your approach.
Only invest in businesses you thoroughly understand and where value is straightforward to estimate. Diversify your portfolio appropriately across sectors, market caps, countries, and bond terms. Pay attention to taxes and minimize costs. Know when to hold cash. Cash provides flexibility to buy bargains during downturns. To sum it up, the intelligent investor emphasizes rationality, patience, and analysis over emotion, impulse, and speculation. While markets have evolved, Graham's principles are still highly relevant for long-term investors. Remember, Graham's goal was to reduce investing to a rational, systematic process for ordinary investors, and he accomplished that brilliantly. Even though markets are complex, value investing principles are simple and timeless. Focus on buying quality assets at below intrinsic value. Study Graham's methods. Always insist on a margin of safety. And above all, be patient, disciplined, and unemotional. Thank you for watching today's video on Benjamin Graham's The Intelligent Investor. Stay tuned for more educational content to help you become a better investor.